Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back. Sonu, the long wait is over. We've had so many people ask us, what do you think is going to happen in 2025? Well, everyone, welcome to episode 118 of Carson's Facts versus Feelings. Here's our 2025 market outlook, animal spirits. We're going to dive all in. We're going to talk about, economy, policy, stocks, bonds, and probably some other stuff as we go along. But we've obviously had a pretty good run the last couple of years. I think a lot of people remember that. That's why there's been so much excitement over what do you see happening this year.
Yeah.
Maybe we can do a brief review of last year. We really dug in last week's podcast. But I don't know. Maybe let's start personal. I'm just still snowed in. There is so much snow. I've never seen like this in Cincinnati. We're trying to get someone. I mean, we did the best we could. My back's not great. My wife's back's not that great. Kids are out of school 2 days in a row now. Trying to find someone to help clear off the driveway. There's all these people that say they'll do it. And then when you reach out, I don't know. I guess they're busy. I get it. But I'm like, I want to pay you money. please. I'm trying to pay you money. Are you free soda? Maybe come on down to Cincinnati. Help me. I don't know.
Do you have dynamic pricing for, people who shell snow over there in Cincinnati?
I would pay about anything right now. I did get out last night. I said, I can't take it anymore. Stuck in my house. I was like, I got to go. And the roads are okay. It was just getting out of the driveways. For those who are on the roads are okay. And got some food and just drove around and got some fresh air. It was nice.
Just have some Campbell's tomato soup and
I'm sick of that.
Grilled cheese.
I joked I've eaten a lot of Pop-Tarts. I know that's not good for me. And remember we talked to Dr. Phil 2 weeks ago. I know Pop-Tarts.
It's only been 2 weeks and you're already off the wagon.
No, I'm not off the wagon. Just a couple Pop-Tarts and that's it. I have to eat. Look at me. I'm whittling away to nothing. So
there you go.
We can't have that.
No. Which means you and I need to get together pretty quickly and get some, and hit something.
We don't have a problem there. But anyway, all right. So Sonu, we're here. Let's start with animal spirits. When people hear animal spirits, they think different things. When we kick the title around, it's one of those things where we've done these many times. I've done like 20 of these, past life and this life. Mm-hmm. And some of the themes are like, whatever. It's a theme and let's just go. But I thought when I forget who it was, maybe I think Barry on the team, I think said animal spirits. Maybe it was you. Whoever it did, wasn't me. I know that. But animal spirits, I was like, ooh, I kind of like that. When you hear animal spirits, what do you think of and kind of what does it mean as we dive into our outlook for 2025?
It's the stuff you throw in there which cannot be measured, right? Like we can measure stuff that happens in the economy to an extent, inflation, markets, markets are 25% previous year. You could measure earnings growth. We'll talk about all that, right? But the stuff you cannot measure, right? The stuff that comes from, deep inside, right? Like, you know what? Maybe it's FOMO. Maybe it's like, I've missed the party so far. We've got the S&P 500's up 97% over the last 5 years. Companies are doing well. The Magnificent Seven's doing well. Maybe I need to get in on the game. You can't really measure that, right? And this is not to say we think this will happen, but there is that element of it. I mean, you look at the last 5 years, right? You look at the last 3 years even. Yes, the stock market's done really well. You and I have talked about it. We were overweight equities over the last couple of years, maximum overweight equities in our, tactical models, things like that, right? But everyone else, we were one of the few people at this party in a way. Everyone else is calling for a recession and all of that. But now it's like, you look at Wall Street strategists. I'm not saying, for good or worse, it is what it is. But I don't think anyone's predicting a recession now.
No.
Right?
If you think about kind of what worries me, it's that 2 years ago, I'd be going on TV saying no recession, new bull market has started. And I mean, the look I had heard through the grapevine that there were certain anchors at very big, well-known networks that wouldn't have me on because they said, oh, they don't know what they're doing. And now they ask all the time, So is that a contrarian indicator? I get asked all the time to come on TV now. It's like, oh boy. So anyway,
you look at Ryan's emails and put that into our 2026 outlook.
Oh man, yeah, exactly. but so that does, I wouldn't say worry me, but it's definitely got my attention. I look around, long-term bears saying they're sorry. Markets obviously falling apart, and some of those bears have done that in early December. That's got my attention. But again, there's still a lot of reasons. Our friends at Bespoke, who do just amazing work, big fans of Bespoke. Yeah. They did some study, and I'm going by memory here recently, but they looked at what do the Wall Street strategists think the year is going to do, and does that year play out like that? They didn't really find too much. I mean, there really wasn't any correlation there. But again, 2 years ago, the median strategist, over 50 of them in a Bloomberg survey, said negative returns. That was in 23. First time ever, at least going back like 25 years of data. When everybody's thinking alike, somebody isn't thinking, and we came out and said, oh, maybe not. And sure enough, we're up like ballpark 70% the last couple of years, 100% total return the last 5 years. Again, there's some more bulls out there, no question. So maybe we don't gain 20% 3 years in a row. And maybe we go there. Because this is what people want to hear on the YouTube channel. We've started sharing charts and videos and cool things. So we are sharing right now our forecasts, I guess we'll call it, for this year on stocks and bonds. And let me make sure I've got it here.
Do we have the right one?
Yeah, let's make sure it's the right one. I think it's the right one. We think stocks on a total return basis will gain between 12 to 15%. So pretty solid, not as good as the last couple of years, but better than an average year. And then bonds, remember, bonds only gained like 1% last year. That's the Barclays Ag Treasuries are virtually flat. We think bonds do a little bit better, between 4 to 7%. So between 12 to 15 on stocks, overweight equities is where we're still placing. And then bonds, 4 to 7, a decent year, but still think stocks do better. So we're going to dive into all that, Sonu. What do you want to add, just kind of high level on those two important, and I guess no recession. We don't quite say that, but it's implied. We don't think there's going to be a recession. We don't really make earnings calls or economic growth calls, but we're still pretty optimistic on that front, like we're going to talk about. Go ahead.
Yeah, I think if you look back last year, even the last 2 years ago when we did this outlook, you probably see, wait a minute, you guys are kind of still in the same range, 12 to 15%. And now mid-year outlooks, we took it up. I mean, there's momentum always works. I mean, you want momentum. And that's why I think animal spirits are also important, right? You want more people participating in this, looking to get in on the rally, things like that, looking to get into this bull market. But one thing I think we didn't talk about too much last year and even the previous year, because I think it was already, ingrained that there would be volatility. But now it's like, I don't think many people are actually talking about volatility. And we are thinking that, this year could be a little more volatile. We're still positive.
Right.
We still think there'll be no recession. But we think there may be more volatility to come. So this is something we'll touch on as well.
Exactly. We kind of finished last week's podcast talking about the idea that, I mean, we'll get more in equities, but I think there's going to be double-digit correction some point this year. That is not abnormal, and you didn't have one last year, so just prepare for that, right? I mean, planning's an important thing. We do that all the time around here. We're looking at the future, what could happen, what might not happen, pricing things in. I would be pricing in, expecting potentially some type of at least a double-digit pullback at some point, peak to trough during the year in stocks. Perfectly normal. But all right, Sonu, we'll talk about the economy and policy, kind of lump those a little bit together. Maybe start with the economy, work our way into policy, because they're cousins. Talk about stocks, a good deal, equities, obviously, and then we'll finish up with bonds. Probably not as much to say about bonds. Honestly, some of the bond discussion probably comes around in the economic and policy discussion when we talk about rates. But overall, let's start with the economy, right? I guess so goes the economy, goes the stock market a lot of times. You have been one of the very, very few macro strategists / economists, along with Neil Dutta and a handful of others.
I get worried when you say that, but no.
Yeah, well, that has been pushing back for a while against the constant negative, headlines. What do you see this year from an economic point of view? Where do you want to start?
Mostly good, actually, but maybe we'll just rewind, and I won't take too much time.
Okay, yeah.
I mean, we have a new administration coming in. The potentially incoming Treasury Secretary, Scott Bessent, has said we want 3% growth. Okay. Well, over the last 2 years, we've got 3% GDP growth. We're there, 3% GDP growth. The Congressional Budget Office, before the pandemic, predicted that the economy would be at a certain place, would have grown about 7.5%, something like that, over the, next 5 years. This was before the pandemic, right? It was around January 2020. What's happened? The economy has actually grown 2.5% better than that after adjusting for inflation. I think we have a chart on this, showing, what the economy did relative to the CBO's, expectations, right? We are about 2.5% better than they expected. That's with a worldwide global pandemic couple of bear markets, right? Yes, the stock market's not the economy is not the stock market, but look, the economy is where profits come from, right? And we'll talk about that, right? But yeah, the economy is done well. And what drives the economy? Now, this is the forward-looking stuff. What drives the economy? 70% of the U.S. economy is consumption, right? What drives consumption? Incomes. So that's the first place to look. How are incomes growing, right? And now when you talk about income, we talk about aggregate income, right? This is a product of, I think we have a chart on this as well. We'll put it up. Aggregate income is the sum of employment growth, wage growth, and hours worked, right? Employment growth is actually tricky now because the latest data, and this is a big difference from what we were talking about a year ago, 2 years ago. Hiring's down a lot, Ryan. The hiring rate, we just got the latest JOLTS data, Job Opening and Labor Turnover Survey, that came out yesterday. Today, we are recording this on the 8th of January. I mean, this may be released only next week, but on the 7th of January, we got the JOLTS data, right? The hiring rate, how many people are being hired relative to the labor force, is down to 3.3%. That's all the way back to where it was in 2013.
Wow.
In 2019, the average is 3.9%. But then you think, wait a minute, why are payrolls pretty strong? Payrolls are averaging about 170,000 or something like that. Well, that's net employment, right? When I talk about hiring, we're talking about gross hiring. But net employment is strong because separations are low. Quits are low. People aren't quitting their jobs. Now, that's not a great thing,
right?
Because it's harder to find a job, and folks know that, right? But the layoffs rate is really low as well. The layoff rate is at 1.1%. Before the pandemic, 2018, 2019 was running at 1.2, 1.3%. We just got claims data literally this morning as we were talking.
Right.
At
really low,
right? That means,
there's some holiday stuff in there, though. I mean, that's I'm skeptical, but it's still going the right way from where it was a few months ago.
Exactly. So what's the big picture for the employment? This is a very good job market if you're happy with your job, right? I'm borrowing from one of our favorite labor economists, Guy Berger. Shout out to him. Yeah, if you like your job, if you're happy with it, you stay there. Wage growth is relatively strong. That's the other component, right? Wage growth is running about 4%, something like that, 3-4%. That's consistent with 2% inflation, by the way. We'll talk about that. But it's not a great job market if you have a job, but you're looking for better opportunities. There aren't too many of that. And you're like, you know what? I'm just going to stay in my job. And it's, I don't want to say bad job market, but I'm close to that if you don't have a job and if you're looking for one.
Okay.
Right? I think that's the big picture with respect to aggregate income, because it's going to be driven by, I think, wage growth as opposed to employment growth. That's a big difference from what we saw the last year and the previous year.
Good points there. Again, it's as simple as if you have a decent labor market, and we think we do. I mean, there's some cracks out there. I mean, again, layoffs are very low, but again, people aren't really quitting. And when do you quit? Usually when you have a better opportunity. Maybe you get fed up, but most of the time because you have a better opportunity. I'm a perfect example. In 22,
2.5 years ago.
Yeah, right? 2.5 years ago, a lot of people left their jobs back then. Better opportunity arose for me, and thank God I did it. And here we are. So, a lot of people did that, and it's not as easy, I guess, to do that necessarily right now. But believe me, there are jobs. Just go to carsongroup.com and look. We're hiring like crazy. Yes. Okay, so there are companies that are hiring. So I don't want to be like, oh, nobody's hiring. I just look around us. Oh my goodness, we're hiring. We're hiring on our team, by the way. So if you want to work with us, check out carsongroup.com. I'm sure somewhere on there is all the job stuff, and you can see a couple of roles are open on our team right now. So check it out. But let's talk about like consumers a little bit more. Balance sheets, and we'll put this chart up right now, and Drew, I'm going to send it to you right now. But corporate balance sheets, you look at, liabilities, assets, things like that. People are in really, really good shape, right?
Yeah, exactly. And you think about three things that the economy is going for it. One, as I talk about, aggregate income growth is strong. But the second part is consumer balance sheets, right? Household balance sheets. If you look at assets as a percentage of disposable income, because that's a way to compare apples to apples.
Good point.
You always talk about denominator blindness, right?
Yeah. Look at all the debt that's out there. Well, people are worth a ton more than they were 20 years ago.
Right, exactly. I'm looking at the chart. Like assets as a percentage disposable income is running around 850% of disposable income, right? And then it's okay. The other side is liabilities. We're talking about mortgage debt, credit card debt, student loan debt, all of this stuff, right? Car loan debt. That's about 96% of disposable income. By the way, that's lower than where it was a year ago. It's lower than where it was 2 years ago. Before the pandemic, 2019, fourth quarter, just before the pandemic, it was about 101%. 96% is not very different from that, but it just tells you that there's not a lot of borrowing in this economy. The economy is running on income growth, which you just talked about.
Right.
But people have this buffer because stock prices have gone up. Real estate prices have gone up. That's not what we saw after the great financial crisis. This is a
No,
very
not at all.
different situation. Households are in good shape. So even if wage growth comes down a little bit, maybe it eases from 4% to 2.5%, 3%. I mean, I think then the inflation picture looks even better
Well,
than
I was
it
going to
is.
say then
That's
inflation's
what-
probably
yeah,
better. So,
right.
what do you really want here?
But there's room for people to, save less because their net worth is better. And historically, what we've seen is that as net worth starts to go up, the savings rate starts to fall. We've seen a little bit of that, but over the last year, I think the savings rate is consistently around, 4.5%. When I say savings rate, what does that mean? How much are you saving every month out of your income, right? You're not consuming that. That's what you mean by savings rate. But it's a good situation. So one, aggregate income is good. Household balance sheets, too. That's the second point. That's in good shape. Third one, I would say productivity growth, right? That's that magic elixir. You and I have been talking about productivity growth, I feel, for at least about 14, 15 months, right? And
Yes.
shout out to our friends at Employ America. They touched on this, way back when. But that's the magic that allows, everyone talks about AI and stuff like that. So we don't think AI is what is driving productivity growth right now. Productivity growth is running about 2.5% over the last several quarters.
And let me just jump in so people understand this, because I go on TV all the time and say productivity, and there's AI. So no, we're not. Maybe there's a little sliver in there, but we're not seeing explosive productivity because of AI yet. And I think that's such an important concept that a lot of people don't quite realize. And that's why there could be a longer streak, potentially, of stronger productivity once you start to get these AI growth in there, right?
Right, exactly. Productivity growth between 2015 and 2005 and 2019 was about 1.6% annualized.
Okay.
Over the last 6 quarters, it's run about 2.6%. Right, so it's well above trend. Why is that? And I think a big part of it, not the only part, a big part of it is a strong labor market. Right. And that's why a strong labor market is important to this. We don't want to break it. And there are risks. Like I said, hiring has started to slow down. But, net employment is high because, quits are low, layoffs are low, things like that. But we don't want to screw this labor market up. I think the Fed is aware of this. We'll talk about the Fed too. But what does productivity growth allow you to happen? It allows you to have strong wage growth with low inflation. Right. Because wage growth is productivity plus inflation, right? And that's the magic that allowed Greenspan in the mid to late 90s to lower rates and for inflation to remain benign, and it was productivity growth. So I think that continues as long as we don't get a recession. And for this year, we're not expecting a recession, right?
No, that's right. Boy, so school's out and basketball practices are all just going all over the place right now.
So productivity is low.
Yeah, I'll tell you. I don't know. It's like now
it's going the other way.
No practice this day. I'm trying to keep up here. You mentioned that, and this is a theme we've been talking about for many quarters now. 6 quarters in a row, productivity's been strong. It's this magic elixir that can put a lid on inflation, which we'll talk about next. Allow for the Fed to cut, allow to pay higher wages. We saw it in the mid to late 90s, and history doesn't repeat itself, but often rhymes. Mark Twain, we've used it 1,000 times, so a lot of other places. Back then it was the internet. This time it's AI. There are some similarities. But the other thing, Sonu, I guess you said a strong labor market, but would it also take an aging labor market? What I mean by that is what we've just seen. Nobody's really quitting their job. So they're pretty experienced at what they're doing. Remember in 22, everybody's quitting, jumping across the street, make more money, but they weren't as productive because it takes you, who knows how long, but let's say 6 months to train somebody. And once you're there a couple of years, they finally know what they're doing. Is there part of that too?
No, exactly. How long did it take you to get your spreadsheets up and running after you joined Carson, right?
I've been here 2.
I've been here 1 month or something.
I've been here 2.5 years. I still don't know what I'm doing half the time. So trust me, it takes a while. Yeah.
No, that's a good point. There was a ton of hiring in 2021 and 2022, especially in the cyclical sectors of the economy. We're seeing less of that now. But what happened? They hired a lot of people, and when you hire a lot of people initially, they're not very productive. But then companies have to spend money, and a big part of we talk about R&D and CapEx and spending on chips and things like that, but a big part of company spending goes into worker training, right? That is a big investment. And what's happened is companies did that in 2024. I think hiring slowed down because, you're getting more out of your employees. Yes, there are a lot of job openings, but I think companies are becoming a little more judicious about who they hire, how they hire, where they hire from, all of that, right? We see that as well, from our own personal experience too. It's not like there's no hiring. There is hiring, but I think companies are becoming much more judicious about that because they've got pretty productive teams doing their work, I mean, not to tout our own team. I think we are doing a pretty fantastic job ourselves too. But yeah, no, I think that's the picture, right? That's why now workers have been in their jobs for 2 years, 2.5 years, 3 years. That's a pretty good situation for productivity to grow. And it would be one thing if we had a lot of unemployment and workers stay in their jobs because they're scared to look for a new job. And at the same time, employees could say, you know what, we're not giving you a 3-4% increase in wages. We're giving you only 1.5%, 2%, which is what happened in the last decade, right? That's not a great situation because, ultimately how much income I earn is going to be what I spend on. It's going to be dependent on that. If I earn more, I'm going to spend more, right? So it usually translates that way. And that's what we're seeing right now. But with productivity, that extra spending doesn't have to convert to inflation, and that's the story here, I think.
No, I think we've covered that pretty well. So that's again a theme we've talked about for a while. So you've been all over it, and obviously it's been playing out very, very nicely. Now let's talk about maybe risks for a minute here. We've got the housing market as yields continue to move higher. Obviously, doing a number on housing markets. Just look at mortgage rates. Nobody wants to move anymore unless you really have to. How worried should we be? I know housing is like a small sliver of the economy technically, but it's kind of like on steroids. Like it moves a lot either way. So it absolutely can kind of push the pendulum for the overall economy to a degree if it's really strong or if it's really weak. How bad could housing get if yields, which we don't expect, by the way, to stay high, but let's say they do. How bad could it get?
I mean, mortgage rates went up to above 7, close to 7.5% a couple of years back, 2022, and the Fed was really ramping up, right? Now they've gone the other way a little bit. And housing really dragged on GDP. It dragged on GDP for a good 9 quarters there. A couple of quarters, it was really bad. And that ended in 2023. And 2024, this is, you and I talked about it last week. This is one of the things I think I got wrong. I was hoping housing would be, would come back and start adding to GDP across 2024. It did for a little bit there, but then interest rates went up. Mortgage rates are back to 7.3%. I don't think housing works. I don't think housing will be a massive drag on GDP, but I don't think it adds anything. That could be the difference between us getting 2.5 to 3% GDP versus closer to something to 2% GDP growth, for example, 2 to 2.5%, right? Because the difference could be housing there. Look, mortgage applications are down 20% since November, Ryan. Refinancings are down 20% since November. It's down 65% since September, right? That's the impact. And you want housing to work. Housing, like you said, is a very cyclical part of the economy. Even though residential investment makes up just 4 or 5%, maybe it's about 5% of GDP. But it adds a lot of volatility there, right? And we want housing to work. I mean, we want people to buy homes, buy furniture, things like that. It creates a lot of activity and it gets into builders' animal spirits as well, right? If builders think, oh, there's more demand down the pipeline, we're going to build more. What are they doing now? They are completing the homes. There are a lot of homes being in the process of being built. They're completing all of those buildings now, but they're reluctant to start a lot of new buildings, right? New homes, things like that. So completions are running, and we have a chart of this, I think. Completions are running about 25% higher than, starts, for example, across the housing market. So it's not a good situation. That means not a lot of animal spirits in the housing market, Ryan. That's all I can say.
No, and I'm trying to get that chart right now.
See, I'm trying to rope in, animal spirits here.
You're doing a good job. So that's one potential worry. And on the YouTube channel right now, we are sharing kind of a SWOT analysis potentially of where we see some strengths, some weaknesses, some threats.
We thought it'd be a nice framework to think about. Okay, there's a lot of uncertainty with respect to policy. How do we think of that with respect to, but at the same time, we know there are certain good things going for the economy. We just talked about that.
We talked about the strengths and the
good
stuff.
And the weaknesses, I think just interest rates. I think those are the weakness. I don't think it's a threat. I mean, housing is weak now, like period, right? It's like the threat is, could it get weaker? But there are opportunities too. I mean, the Fed could continue cutting. A lot of people, I got a couple of things yesterday saying, oh, we can't wait for the outlook because we want to see what you guys think about Fed policy, right? So you want to talk about that, Ryan, next?
Yeah, I mean, we've got the threats. When do you want to talk about the threats? Because this kind of lumps, or you want to talk about the Fed, then the threats? How do you want to do it?
Let's combine both, right? The Fed, I think, is an opportunity. More rate cuts. We expect 2 to 3 rate cuts this year. but I don't think it happens in the first 3, 4, 5 months of this year.
Right.
I think the Fed gets spooked by a little bit of, what they call sticky inflation around 2.5%, 2.6%. We'll talk about why we think the inflation picture is much more benign. But I think the risk, the threat is also there in that. It's the other side of that same coin, right? If they think, and I'll put this, my bias, if they think misguidedly that inflation's too high, they keep rates higher for longer, they don't cut at all. I think that's a risk. I don't think that will happen. I think we will get cuts, but I think we may have to sit on our hands waiting for that for a while. So in the meantime, you could see housing continue to weaken, and go forth. And the hope is, by the time the Fed gets ready to act, how that housing weakness hasn't spread elsewhere.
No, that's a good point. So the market, right? The market is saying maybe like what, 2 cuts this year, maybe
one cut
a tad
right
less?
now.
Okay.
Yeah, 1 cut and maybe 50% probability of a second cut. That's where the market's at.
So you think about where we are maybe different than kind of what some other places are saying, what the market's saying. We think there could be a little more than that. But again, it's not going to happen early in the year, kind of like last year. At the start of the year, like we talked before, expected 6 to 7 cuts. Well, it didn't happen until September, and we didn't get that many cuts. So we think, again, it's going to be later in the year when inflation data starts to continue to improve. We talked a lot about it. There's shelter, which is lagging components, some other lagging components. But you take out shelter, inflation's running sub 2%. So there are some positive parts to inflation that are out there. The real-time rents, and again, rent and shelter make up a lot of inflation. A lot of the reason inflation's been sticky and lagging, so to speak. Those are showing drastically different numbers, much better numbers, if you will, like negative year-over-year numbers in Apartment List and Zillow. We're not seeing that in the government's data, so we continue to think there's some improvement coming on the inflation front. Now, trust me, the Fed knows this, economists know it, everybody on CNBC knows it because they're talking about it, but still, you saw goods prices continue to improve, services doing all right. I think there's still some reasons to think that the Fed will be cutting, and it's not because of a weakening economy. Let's be very clear. We don't think it's because the economy is going to drastically weaken. Could it weaken a little bit? Hey, if interest rates stay higher, maybe it could. Maybe that'd give more juice for the Fed to cut, actually, but we don't think that's the base case why we'll see 2 to 3 cuts this year.
I think that's an important piece, right? Shelter disinflation is happening, and there's more to come. There's more to come. And that's why I think everyone is talking about, inflation's sticky around 2.5%, 3%. I think it's sticky, but it's around 2%, right? Because I think that we get to see shelter disinflation. People talk about, services inflation is high, but why is services inflation high? Because of stock prices. A big part of services inflation, at least within the Fed's preferred PCE index, personal consumption expenditures index, is portfolio management services. Yes. Right? That's running high because stock prices are going up. I mean, I don't think any of us want lower stock prices because inflation will go. No, that's the good thing is the Fed is, I think, aware of that, right? Fed Governor Chris Waller talked about this morning, saying that there are what we call imputed prices, right? He's referring to this sort of stuff, portfolio management services. That's what it's making inflation sort of look sticky. But look at the forward-looking data. I don't think there's anything worrying relative to that. Wage growth, we talked about, it's consistent with 2% inflation. It's running about 4%, slightly higher than 2019, but we have better productivity now. Consumer expectations of inflation, it's consistent with 2% inflation as well. Right? We got the December data for business expectations of inflation from the Atlanta Fed. That's at 2%. That's where it was before the pandemic. Listen to businesses. They don't think inflation is above 2% right now. So all of these, I think, are the forward-looking data tells you that maybe inflation's sticky, but it's sticky around 2%.
So, Sonu, you might be shocked to hear this, and I'm shocked as well. We probably need to pick up the pace a little. We've been really diving in. I don't know, a long time. We haven't even gotten to the stocks part, but we got more to talk about. Okay. Let's So we've got the Fed, we've got inflation. Let's talk about kind of, again, we can put up the SWOT chart, the threats, right? The threats that are out there. I mean, tariffs, right, are out there, and a stronger U.S. dollar. Let's talk about those 2 threats here, and then kind of move on to equities.
Yeah, I think the tariff, the most beautiful word in the English dictionary. That's what President Trump incoming. I don't know. It's weird to call President Trump or President-elect Trump. He was already president.
I don't know.
And we refer to ex-presidents as president, so I'm going to call him President Trump, and as opposed to President-elect, right? But look, tariffs have been President Biden didn't take away the tariffs they put in 2018, 2019. We were okay. Right now, one big part of the whole tariff threat, we saw noise around that this week as well. But there will be continuing noise, which is one reason we think there may be more volatility. But tariffs itself, I don't worry about that seeping into inflation. And one reason is the dollar. the dollar adjusts. That we've seen the dollar rise by about 7-8% since the end of September. Part of that is after the election. It wasn't only the election; it's because U.S. economic growth is running better than every other country in the world on a relative basis. So interest rates are likely to stay higher here than outside the world. I think the easing cycle will be greater outside the U.S. as opposed. We were just talking about the Fed, right? And market's not expecting more than 1 to 2 cuts this year. So that's reflected in the dollar too. But I think the dollar is a threat, right? The strong dollar means, U.S. company earnings may be lower than you expect because, 40% of revenues come from outside the country, right? And then,
we are sharing that chart right now on the YouTube channel, the correlation between a stronger dollar or just a dollar in general and earnings.
Right, exactly. And the other part of a strong dollar, it hurts U.S. manufacturing. It hurts U.S. exports, right? So that's a potential threat. I would say that's a threat as opposed to a weakness. So part of it is also global growth is weak. So, who are you going to export to if nobody wants to buy stuff, right? But the dollar is, it's a constraint there as well. And the other thing is international equities. I mean, obviously, nobody likes international equities. If you're here, everyone likes U.S. equities. Like, why should we even bother allocating to international equities? Well, you want some diversification. That's for one thing. I mean, we can always talk about that later. But the dollar is a headwind for international equities because, if the dollar goes up, that means your the stocks that you buy outside the country, which is in local currency terms, those are worth less too. So that's a headwind. So that's what worries me about the dollar. I think the dollar is a threat.
It is a threat. And I will say this, though, when you think about crowded trades, what's everybody saying? I mean, we're hearing that a lot, right? Because you just mentioned a 6 or 7% move since the election. I want to be very clear. That's a huge move for a currency. Yeah. Like that's, I don't know. The exact
and for the
number,
world's reserve currency, right?
Yeah, that's like a 20% move for stocks. I mean, that is a really big move, especially for the world's reserve currency. And again, you look at 22, for instance, the first 10 months, dollar was really strong. Everything else was weak. During COVID, March of 2020, go look it up. Bonds down, stocks down, gold down, dollar up. Historically, when a dollar gets a strong bid's a word we use for a lot of strength, that's not always a good thing. Now, honestly, stocks are hanging in there, all in all, with the dollar strength we've seen since the election. But if it continues, that is a worry of ours. So, well, yes, we're calling it a threat. And again, a lot of people are talking about it. That inner contrarian in me, maybe I'm just a glass half full type of person. I think that dollar is going to have a peak here sometime in the first quarter and roll over. But we'll talk about it and we'll continue. But for now, that is absolutely a threat. All right, so let's wrap this up. We think the Fed is probably going to cut more than the market thinks. We think inflation is still not even last year's problem, 2 years ago's problem.
2 years ago.
Inflation keeps improving. The economy is probably going to grow above trend. Productivity is going to be strong. We're going to avoid a recession. I covered all for the economy.
I
Highlights,
think so.
right?
Yeah.
So all in all, pretty solid, which we really covered our bases here. But that is part 2 to this conversation. How are my stocks and bonds going to do, right? We've covered some of this stuff already, actually, so we can kind of move forward. But we think stocks, again, after back-to-back 20% gains on the S&P 500, will gain between 12 and 15% on the year. What are some of the big drivers you think there, Sonu, that could, again, help this bull market continue?
2 big drivers. I mean, one is earnings growth, obviously. Even last year, forward-looking 12-month earnings went up from $242 a share to about $272. We'll share the chart. And
there now.
That's what drove the bull market, right? Out of the 25% gain for the S&P 500, 13 percentage points came from earnings growth, right? 2% maybe came from dividends, something like that, right? The rest was multiple growth. And I think over the last 5 years, or even last 3 years, most of it has been earnings growth. There's no reason to think that stops, right? And what's driving earnings growth? 2 pieces. You could break down earnings growth into sales growth. That's coming from nominal GDP. And margin expansion. I think that is an underrated story. Margin expansion. Forward-looking margins are up to 13.6% for the S&P 500. That is a story of operating leverage. It's a story of productivity for companies, right? As sales increase, they can increase margins. I think that continues to be the case in 2025, Ryan.
Well, I like it. I mean, again, record earnings, record margins. Let's keep this simple. Those are things we've shared, I think, in the last couple outlooks. Right. The dual tailwinds to a stronger economy and probably a stronger stock market. Pretty straightforward. Now, one other really cool. I've talked about it, but we're going to talk about it again. We'll share the chart here. This bull market is actually young. And I know people hear that. So what are you talking about? I mean, we're over 2 years old. This bull market started when the last bear market ended October of 2022. But so let's just call it into the third year, just into the third year. Now, Sonu, when you go back 50 years, and you look at the last 5 bull markets that made it into their third year, so once they started to get a little bit older, if you will, they kept going. The shortest was 5 years. The average was 8 years. We've had some double-digit bull markets. We're not going on record. We're going to have an 8-year bull market. We're not going on record and have a double-digit bull market. But what we are saying is this third year of a bull market, things will probably continue. And in fact, it's likely. The example I like to give, I think it makes a lot of sense. Hopefully, a cruise ship. Once a cruise ship gets moving, it's really hard to turn around. They don't slow down all that fast. It just keeps going. That is like a bull market, and that's where we are with things right now. Now, full disclosure, something for everyone. We're also going to share this chart here. Third year of a bull market, sometimes choppy, sometimes not all that great. Why is that? Because years 1 and 2 are spectacular. Well, year 1 of this bull market honestly wasn't that great. We heard from a lot of people, it's kind of weak. But the second year of that bull market was spectacular. Now we're in the third year. Again, we think we're going to have better than average returns.
Finally calling it a bull market, do you think?
I don't think so. I love when they call it a melt up. That's like a backhanded compliment. You see the media, stocks melt up. It's like, well, yeah, they're in a bull market. Anyway, but so maybe the third, that's again why we think maybe we don't get 20% 3 years in a row, but double digits, double digits into the teens, still possible. But again, that third year is kind of a catch your breath moment, which gets us to, again, the idea that this year is not going to be just from the bottom of your left to the upper of your right screen. It's going to be choppy. It's going to be frustrating. We've got new administration. We've got the headline risk and all those things we've talked about already, the threats we talked about, but there's still more positives. There are still more positives. What drive long-term stock gains? Profits, profit margins, animal spirits. A dovish Fed. Is a Fed purely dovish? Maybe not, but they're sure not hawkish like they just were. I mean, those are all things that got us to the dance, and those are things that are going to continue, we think, to keep us going. And again, the bull market is actually young, surprising people when I say that, but that is what history tells us. Sonu, what do you want to add about equities here?
No, I think all of those things we talk about, the drivers, both profits, margins, and then even animal spirits. And some of that could come from fiscal policy, right? Fiscal policy, I think, is primed to prime the pump, so to speak. I mean, people like they're going to get more deficits. But to your point, you just talk about volatility. We expect more volatility because it's not going to happen quickly, right? We have Republicans in Congress, in the House, have a very small majority. So, but usually you think, okay, a do-nothing Congress is a good thing, but this time they actually have to do stuff.
Yeah, they promised a lot.
And they need to raise the debt ceiling, right? We may see some volatility associated with that because they're going to need the Democrats to pass, an increase in the debt ceiling. And then you think about January 1st, 2026. Okay. Everyone's taxes are going to go up because the Trump tax cuts, which they passed in 2017, is going to expire. Right.
Okay. Wow.
And they said they're going to renew it. President Trump has talked about even more tax cuts potentially coming. We'll see. But they actually have to proactively do something so that fiscal cliff doesn't happen. How quickly they do it, that's the thing. That's what could drive some volatility. I think it eventually happens. Nobody going into a midterm year, no politician going into a midterm year is going to want to tell constituents your taxes went up. Right. So that's going to happen, right? And that will be, I think, a potential boost, but it may come only later in the year. We may see some volatility associated with everything that happens with tariffs and the Fed and fiscal policy, tax cuts, debt ceiling. So there's a lot of factors in there to add volatility to the equity market. But I think the other side of that same coin is they're all opportunities too.
No, well said there. There's hopefully more opportunities again on this bull market. But let's kind of dive in a little bit more then. We've liked the U.S. for a while. We still like the U.S. relative to the rest of the world. Doesn't mean you shouldn't have a little EM. Doesn't mean you shouldn't have a little bit of developed if the right portfolio, if it makes sense to you. We just still think the U.S. will lead again. Is that the easiest way to put it?
I think so. U.S. economic growth has, that's why we started the conversation. U.S. economic growth since the pandemic has grown about 11% after adjusting for inflation, real GDP growth. The next best, I think, is like Canada or something, about 4 or 5%, something like that. Japan's at like 2 or 3%.
Which might be part of the United States before long. I'm just being quiet. I don't want to go there. I'm just being playful.
And there you go. We're taking even the second best one out of that.
There you go.
That's right. So we'll get a lot of oil too. So suddenly, the U.S. is already the largest producer, and now with Canada's oil. No, okay, forget that. And then Greenland and all of that.
Oh yeah, we'll be quiet now.
We won't go there. But I guess we already went there. But no, look, you want to diversify your portfolio, right? I mean, we talked about.
Yes.
I think there's this chart going around, a good one, showing that, look, out of the S&P 500, the top 10 companies make up 39%. And I think that's a worry. I mean, for one thing, what's interesting is if you look at every other, you and I have looked at this data, right? We looked at it together. If you look at every other stock market in the world, the 20 other countries that we looked at, the average weight of the top 10 stocks is about 58, 59%. The median is 61%. I'm not saying the US at 38, 39% is a good thing, but we are less concentrated than a lot of other countries' stock market. I think only India and Japan are lower than the US, right? Japan's at 28%. But then if you put all of the rest of the world together in the MSCI ACWI X US index, the top 10 stocks make up about 17, 18%, right? You can do that in the US too. You don't have to put all your eggs into the tech basket or the growth basket. There's small caps, mid caps, there's value stocks. And I think there may be some broadening out this year. We haven't seen that. Famous last words, I know. But I think there will be some broadening out. We may have to, again, wait a little bit, as we get through the year, as we get through the middle of the year. But I think we'll see that broadening out. I think we'll see that, diversification. Even, I'm not talking about stocks and bonds. I'm talking about just within the equity market. That's still one way to manage risk, right? Like I said, you don't want to put all your eggs into one basket.
Yeah, I mean, large caps have led like 3 years in a row by a pretty wide margin. Growth has led 3 years in a row by a pretty wide margin. If you look at the aughts, as we call it, from 2000, 2009, like the worst performer, large caps. All right. EM did well. Commodities did really well. Now, that's, we're not saying that's necessarily going to happen again. We're just saying these cycles, if you always chase a shiny object, it's our job as a research shop, and we work with so many amazing Carson partners. Their jobs also to help their clients realize maybe let's not always chase a shiny object. Just because it's the hottest thing the last 3 years, will it really be the hottest thing 3 years from now? Maybe, but probably not. That doesn't mean you don't want to have tech exposure. Doesn't mean you have communication services.
Underweighting tech, right?
Not at all. We're even weight tech here. We still think there is career risk here. If tech goes crazy and you're underweight, that's not good. So, but it still makes sense to have some technology. That's where the growth is coming from. They're pricey, but that's where the growth is coming from. So I think it's really important to, right now, if someone made a bunch of money in tech the last couple of years, maybe look at some of the underloved, underappreciated areas like small caps, like mid caps. I know they're dirty words. And I know last year we talked about them a lot. They didn't do that great. But you know what? Small caps still gained like 12% last year. Mid caps, I think 15, 16. That's still better than developed. That's still better in emerging markets. That's still better in a lot of other places around the world. And I get it. It's not up as much as this, large cap tech. We get that. But just be aware when you manage money, when you have a diversified portfolio, to kind of, rebalance, if you will. Yeah. It makes sense. And it's easy to do rebalancing start of the year. Because it's like, maybe I should rebalance this new year.
Right.
So maybe it's something to think about there. Well, let's talk. I mean, I know we've gone, we probably want to wrap this up soon in less than 10 minutes here, but we talked a little more. Want to talk a little bit more sectors? We kind of talk cap size sector. Let's kind of wrap that up.
Yeah, look, we like mid caps and small caps. We've liked them for the last year. Yes, we talked about this last week that it didn't work. But again, this is, I think, important to get right when you think about portfolio construction. You want to size your bets appropriately. Yes, we got that wrong, but it didn't impact us too negatively. And that's because it wasn't a very large bet, right? Our big bet was stocks will do better than bonds. The US will do better than international. That was the biggest drivers of our performance, as opposed to small and mid caps will do better than large. I mean, yes, it was a small bet, but and it was a bet that we made. It was a call that we got wrong. But we're not looking to be invested just for 6 months or 9 months, or even just 1 year, right? It's a long-term thing. It goes back to something you were saying. I mean, we think strategically. We may make tactical moves, but ultimately the idea is you want to be invested for the long run. And for that, diversification is a good thing.
No, absolutely. And we'll talk a little about diversifiers here in the next discussion, talk about bonds and commodities and, different things. So anything you want to wrap up with on equities? I mean, I think we've covered a lot of the stuff we wanted to talk about. How do you want to wrap it up?
I mean, maybe one final thing, like, look, we like tech, right? And tech is honestly the largest weight in the portfolio because, we're neutral on it. And neutral means, tech is very large, right? But we like financials, we like communication services, and that's how we're playing the fact that we think the economy is good. And, I think that sort of underlines how we are thinking about how we translate what we think about economy into portfolio construction and what we like and what we are overweighting and underweighting.
Mm-hmm. Well said. And again, a lot of you will hear on TV, stock market's pricey. It is pricey when you look at the stock market because tech's pricey, communication services pricey. That's where the growth is coming from. Sometimes you have to pay up for growth, but there are some historically really cheap areas like small caps, mid caps, financials, industrials, not historically cheap, but they're definitely cheaper than some of the other areas out there. And there's some timeless things. We did touch on this, I think, last week, but nonetheless, listen, since 1950, there have been 22 years the stock market's gained 20%. 21 years it was down. So the odds of a 20% move are actually higher than a down year. I mean, that's pretty fascinating when you think about it. But I think it's really important for investors and financial advisors to think like that. But, okay, if the average year is like 9%, well, only 4 times since 1950 has the stock market gained between 8 and 10%. So if 8 and 10% is about average, only 4 times. Okay, so these bigger swings, your average up year is up like 17, 18%. Your average down year is down 14. Like you said, a lot of years are up double digits. If you're up for the year, take a wild guess. You're usually up double digits. There's not that many up 2 or 3% years. I mean, there's a few of them. But we're just trying to put some context around these timeless things for investors to know. And again, when you're up 20% for the year, that next year is actually up better than average. Higher than average. When you're up 20% 2 years in a row, small sample size, I admit, only 4 times. Once in the 50s, 4 times in the 1990s. That next year, after back-to-back 20% gains, never been lower. Higher 4 out of 4, up 20% on average. So just because we're up a lot, don't be scared. There's other reasons to be scared. We've talked about them. There are some legit reasons to be worried and scared. But we still think the opportunities and the strength of this economy, led by a strong consumer, suggest that the bull market we're in is not over.
Shall we talk about something really exciting? I think you were going there. Bonds.
Oh, I was like, what are you talking about? Bonds? Their bonds obviously had a rough-ish year last year, up only 1%. Yields had that big spike after the Fed started cutting. But the reality again is it still makes sense to have some bond exposure, to have a diversifier in your portfolio, something that zigs when stocks zag. Although, honestly, bonds haven't always been doing that lately. That's why bonds been a little troublesome. But we were underweight bonds last year, right? Yeah. I mean, we thought bonds would be a little bit better. We thought the 10-year yield would be a little bit lower. Bonds, yeah. But heavily underweight because we thought there are other areas, specifically stocks, that were going to do better. And we're still in that camp, right?
No, exactly, right? But at the same time, when you're heavily underweight bonds, you want some diversification. And bonds can provide you that. We saw a little bit of an example of this in August during the, that yen carry trade crisis, however you want to think about that. But yeah, no, bonds did well during that period. Maybe it's starting to act like a diversifier again. And the good news is that yields are high. Literally, as we talk right now, 30-year yields are knocking on heaven's door. No, knocking on the 5% door. But the 10-year yield is at 470, 475, something like this. I don't know where it is. It may have even moved as we spoke over the last 40, 45 minutes. But look, when you think about bonds, the expected return, your best guess of the expected return for bonds is your starting yield. That's what you get, right? And that's why when we talked about our expectation for bonds, somewhere between 4 and 7%, could be volatile for sure, especially once you get into the long bond area, the longer part of the yield curve. But we think that's helpful still. We wouldn't zero it out. We still like it as part of the portfolio. But at the same time, we are not putting all our cards into just bonds at diversifiers. Right? We like managed futures too. Yes, we think inflation's benign, but it's not a 1 or 0 game here.
Yeah.
It's not 0%. Maybe there's some probability that there's an energy crisis, something like that. And that's why we like, managed futures and commodities, things like that. We also like gold. Right? Instead of just buying 30-year yields, we think real yields are pretty high right now. They could go lower. If they go lower, gold could be something that really benefits. Gold's been a very good diversifier for us over the last, close to 2 years. Right? When did we get into gold, Ryan? I mean,
March of 23, we put a little bit in, and then after the U.S. election, when the dollar surged and gold took it on the chin, we added a little bit more. I like to buy things in bull markets that have violent, scary pullbacks, and that's what we saw in November. And gold is it's come off, it's still doing well. So we've got a little bit of gold. Things that managed futures, little bit of cash, not a lot, a little bit of cash. Those are we say diversify your diversifiers. If all you live by is a 60-40 portfolio, 60% stocks, 40% bonds, that's fine. Trust me. Over a long time, you're probably still going going to do okay. But right now, we think that diversifier part, that 40% part, but honestly, we're not quite 40. We're a little bit less because we have more equities, but we're trying to keep this simple. There are other things you can have in that portfolio to help you, and probably, honestly, do a little bit better than bonds are going to do. I still think gold, all things considered, probably has a better year than bonds in 2025, and we definitely thought that the last 2 years as well. I don't think this bull market's done in gold. So anyway, and one other thing, just because we like gold a little bit, and have a little bit in some of our tactical models, doesn't mean we're bearish, doesn't mean we're gold bugs. Yes. There have been many, many years, and I talked about this in 23, when gold and stocks have gone up for years together. There have been some years where they go down together, not as often, but it's normal to have both of those going higher in bull markets, and we think that's happening, and my goodness gracious, is that happening the last couple of years?
Right. I don't think we have to worry about anyone calling us bearish.
That's true. That's true.
But just in case, we do have some gold. But no, yeah, I think just underlying what you said, diversify your diversifiers. Don't put all your eggs into one basket. Diversify even your equity basket. Right.
Mm-hmm. Yeah. No, well said. So, all right, Sonu. So, I think we're probably need to wrap it up. Any final wisdom from Sonu Varghese, sitting in nice, warm, sunny Chicago as we do this?
It is sunny, but it's like 15 degrees.
I know. I was teasing. I knew it wasn't that warm. I know it's not that warm. I was teasing. Yeah.
Sunny. Look, at the end of the day, we think that a lot of opportunities for this market. There's no recession, right? And there are threats, there are risks, but we think the opportunities will overcome that. We may have to wait a little bit, but expect more volatility this year. I think that's going to be, something different from what we haven't seen since, I think, October of 2023.
Mm-hmm. Yeah. No, I can't sum it up better than that. I'll go this route. We're honored that so many people are taking the time to listen to what Sonu, myself, and our team at the Carson Investment Research Team are putting together and doing. You've taken a lot of time just to listen to this very 2025 outlook on animal spirits, and we really appreciate that. There's a lot of great financial advisors out there. There's a lot of great just end clients out there that listen to these things and pay attention to the things we're doing. And it's not something we take lightly. We like to have fun, but at the same time, we know it's extremely serious. And we're just honored that so many people trust us to give us their time, and honestly, in a lot of cases, to manage their money. And it goes a long way, and we're going to continue to do everything we can to help people reach their goals, and to honestly, the other side of things, to help explain what's going on out there, because there's going to be scary headlines. I mean, listen, when the market pulls back a lot, I'm not saying I get scared, but I get uncomfortable too. I do this for a living. It's like when you see a lot of red out there and you see bad news, I don't care who you are, that's going to eat at you, but we're going to do everything we can to make sure we kind of focus on those longer term goals and help people understand what's going on. And
we'll always communicate with you, even during those times. You'll know how we are thinking.
Oh, yeah, right? Exactly.
Whether we change our thinking.
And maybe we don't know what's going on either. Honest to goodness, like maybe something crazy happens, like a yen carry trend went in August. We're not true experts there, but we're still going to say, maybe we don't know exactly what's going on, but we're here for you. We're going to be here for you every step of the way. We're going to tell you what we're seeing. If we don't know, we don't know. We'll be honest. There's nothing wrong with that. But we do know over the long run, stocks are still a good place to be. We think we're still in a bull market, and we know we're honored that so many people continue to listen to what our team is up to. So that means a lot to us. So with all that, so everyone, Sonu and everyone, happy and healthy 2025. Let's keep this bull market going, and we'll see everybody very soon. Thank you. Take care. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.